Hi, this is O'Connor. You got me. And we're up to chapter 12 here. And you know that this area of the textbook in fraud investigation is quite intense. It's very technical. We cannot cover everything, but my job is to try and make it interesting for you as we go through these chapters, chapter 11, 12, and 13. This one being chapter 12, revenue and inventory related financial statement frauds. And the learning objectives are identify revenue-related financial statement fraud schemes, list ways to search for symptoms, understand the importance and ways to follow up, discuss inventory-related statement fraud schemes, ways to search for inventory-related fraud schemes, and ways to follow up. Now, because it's overly technical, we're going to have to break this into a minimum of 2 parts. So this is our first part, where each part will be looking at the fraud schemes, the symptoms, and then ways to follow up. Now, one thing I just want to be clear, this is not an auditing unit, so we're not going to look at all the things that auditors should and should not do. We are fraud investigators, so part of my teaching is to make you more aware of the different types of frauds that have been undertaken, especially by the largest fraudsters in history. And from that, hopefully we can learn something and to keep our eyes and ears open for the appropriate symptoms when we investigate the fraud. So we are over here. We are not the auditors, all right? Our job is not preventative. Our job is detecting and investigating. Our role is reactive, especially when a fraud has been committed. Then we have to investigate and get the evidence. Wow. All right. So let's get into some of the landscape of the big frauds in history that we will come back to in the next 3 or 4 parts, not just chapter 12, this one, but also in the next chapter, chapter 13. As you can see, chapter 12 in this part covers revenue fraud. In the next part, we'll look at overstatement of inventory. But then in chapter 13, statement of liability, overstatement of asset, and inadequate disclosure fraud. And as you can see, the big financial accounting frauds I've listed, there are 25 here. Look, of course, there's many more, but all of these have reported losses of over $1 billion US, except for 2 of them. There was that very early one back in where we're talking about ESM Government Securities, 985. I mention that because it's in the textbook. And also Luckin Coffee, because it's closer to home in Asia. It was a big one most recently, 2019 and 2020. And even that was 300 million. But every other one, the estimated losses is a minimum of $1 billion US. So these are massive frauds. Wow. Okay. And as you can see, we can count 15 out of the 25 had revenue-related frauds, 2 inventory, 8 had understatement of liability, and 12 had overstatement of assets, and there were 9 inadequate disclosures among them. And the ones I put near the top have 3 or more of these problematic types of frauds, Enron being the most famous one, having 4, but Valiant Pharmaceuticals, Sunbeam, definitely had 3, and Adelphia Communications, Lehman Brothers, and following on from that had 2. Then we go down from China, Everglade, and all those below that just had 1. Now, I may have missed a second fraud in that bottom list from 18 to 25, but this is the best I could do after many, many hours of research and study over the weekend. All right. So this is some of the evidential basis that we'll refer to as we look at the different types of frauds. Let's get into this first part. And the textbook does start with a major fraud, and that was of Quest International. And how big was it? Well, it was big as Enron in terms of the loss in market capitalization. We're talking over $100 billion in market capitalization. It was a big fraud at the turn of the century. Quest International was a major telecommunications firm, and one of the biggest frauds that they committed was in the area of pumping up the revenue and they inflated the revenue through DEX shuffling. They inflated the revenue through splitting transactions. They inflated it by bill and hold approaches and round tripping. And one, I'll just explain one in a little bit more detail, the rest in the textbook, but they were selling fiber optic cable rights to Enron, Global Crossing, Cable and Wireless, and they were purchasing them back. But the purchases weren't necessarily booked as purchases, but the sales were booked as revenue, and they inflated the revenue ginormously just because of that, like gains of over $3 billion in revenue just because of that. Like the stuff they did at the turn of the century makes your eyes wander. Wow. All right. So anyway, the 4 executives that got indicted ended up going to jail, and there's nearly a half a page devoted to explaining this fraud in the textbook. Very juicy reading. So just want to start off with a nice story here, and to understand revenue fraud is in this part. So what do we mean by revenue related fraud? I've just given you some examples from Quest Communications, but the most common accounts manipulated when perpetrating financial statement fraud are the revenues and or receivables. Why? Because it's easy. It's easy to do. All right. And the COSO sponsored studies discussed in Chapter 11, they found that more than half of all financial statement frauds involved revenues and or accounts receivable. Wow. The common ways, you just record fictitious revenues and record revenues prematurely. The second most common. So here we have the reasons. There are many different acceptable alternatives to booking revenues according to the accounting standards. It really depends on the business and audit setting. And because of these alternatives, every industry is different. And so it's not like auditors, investigators can apply a cookie cutter approach in looking for what is a good revenue disclosure practice and what is a bad revenue disclosure practice. But here's the other thing, the fraud opportunity, the ease of manipulating net income. It's very easy to create an accounts receivable. Accounts receivable is an asset. You debit accounts receivable, you credit sales. Immediately, bing, your top line goes up. What do you do with accounts receivable? Well, you bury it among all your other accounts receivable, and you hope or you plan for your auditor not to find it, especially if you have hundreds or thousands of these accounts receivable. It's much easier to hide your fraudulent accounts receivable made up. There you have it. Immediate, you have instant revenue. Wow. And you don't have to keep that going on from year to year to year, as you'll find in part 2 when we talk about inventory related fraud. Once we start manipulating inventory, then it rolls over onto the next year and then onto the next year. And so you have to continually enter in fraudulent entries to maintain the inventory fraud. You don't have to do that with revenue fraud. You can stop doing the fraud in any period and keep the one you've done in the past hidden without much effort. Wow. All right. So you've got topside journal entries, just like I explained. You can have premature recognition. You can recognize income before you've made sales, like consignment goods. You can say that you've sent goods out for consignment. You immediately recognize it as sales, even though the goods have not yet been sold. Fictitious sales and documents, forging contracts, misstating work completion. Recognizing work as being 100% complete when it is only 50% complete, especially if you're in a service contract. Wow, immediately your top line goes up. There you go. Revenue related fraud, easy peasy. Wow. All right. So in the textbook, they actually talk about how do you identify the various steps. Well, the best way is to understand the revenue transactions in a company. You first sell goods or services. You estimate uncollectible receivables. Like I said earlier, let's debit receivables, let's credit sales. All right. And 1 or 2 years later, those receivables, we move that across to doubtful debts, and then suddenly you move it across to bad debts. Because remember, you're not going to be able to follow up on a receivable that you made up. So you can squeeze it out and make it go away through the doubtful debts and then bad debts. So you can declare that false receivable as being uncollectible, right? We can look at accepting return goods, and that in effect inflates inventory, which we'll talk about in part 2. But what's important now is to move on to number 4, where we can write off the receivable. And if that receivable originally was false, then you're writing off something false and no one knows the better. All right. And then if it was paid, you could say there was a bigger discount than normal, you collected less cash than normal, and then in the end you collect cash minus the discount. There you have it. Because if you make up the sales at the end, anything that you made up, you cannot collect cash on. So there is 1, 2, 3, 4 opportunities for you to reduce that, say, $100 of fake sale down to 0, because you want to get it down to 0, because at the end of the day, you're not going to collect any cash. You're going to collect 0 cash. So there are 4 different opportunities to move 100 down to 0. And that is how it is done. QED. There you go. All right. So that's the theory or the process of making and extinguishing a revenue fraud that no one will ever know about. Let's have a look at the accounts involved and potential manipulation. So this is in step 2, where you could sell goods and services to customers. You could estimate uncollectible receivables, and you can accept return goods from customers. And these are the accounts involved, and there are various fraud schemes in each of these areas. So my job here is not to outline all fraud schemes, but I'd like to pick out ones that are interesting. And you might find interesting ones that you already know about as well. All right. So continuing on with step 2, there are other types of transactions where you can write off receivables as uncollectible. Remember, we've got to reduce that $100 sale into that fake receivable down to 0, because you're not going to get cash collected from a fake receivable. So you need to write it off. So you're going to use allowance for doubtful accounts. And whatever you don't write off, you could say, oh, there might be a discount on the rest. And so then you're going to create a discount, and then that discount becomes an expense. All right. And so in the end, you're not going to get cash going into the bank. You didn't expect anyway, because you created a revenue out of nothing. And so there are various fraud schemes here associated with these transactions. But keeping this simple, as I said, you make $100 of sale, you create an accounts receivable, you bury it among your other hundreds of accounts receivable, and then you slowly nullify that accounts receivable, either through making them doubtful, make them bad debts, give them a discount, and then the cash becomes 0, and then you're good to live for another financial period. Great stuff here. All right. We could have a look at these common revenue fraud schemes in a different way. And this may help us, rather than to think about, oh, there are 15 different schemes you need to memorize for the exam or for the quiz. I think we can do better with our knowledge if we think in terms of the type of fraud. Remember, these are all revenue types of fraud, but some of these are a manipulation of sales transactions. Okay, so we can think in terms of 3 different types or groups of schemes as follows, where we manipulate the sales transactions, like partial shipments. We manipulate accounting records, like the redating and refreshing of transactions, or just plain corruption, where we have sham sales. In some ways, the round tripping that Quest did with Enron could be associated with sham sales, because they weren't really sales, because they were actually buying back and then creating excess revenues for everyone, but there was no value added created in those transactions for both parties. So if we've got these three different groups, and we can group all of these into manipulation of sales, manipulation of accounting records, and corruption, then we have a better idea of understanding the different revenue-related frauds. Let me show you. And so in the textbook, it talks about the manipulation of sales transactions, the manipulation of accounting records, and corruption, and then sham sales. So I want to give you some examples. The bill and hold sales, they are often used in the tech industry, and similar practices might have been part of the problems at companies like Sunbeam, the Sunbeam Corporation, which was listed in our top 25 earlier. And it's mentioned in it early on in the textbook, chapter 12. Related party transactions, Enron used off-balance sheet entries for hiding debt losses around 63 billion. This is blatant corruption, all right? Related party transactions. You have to collude with the other party when you're going to do these round tripping, like Quest Communications did with Enron. They did with Global Crossing. They did with Cable and Wireless. And then finally, the sham sales, like WorldCom, mentioned in our top 25, they capitalized their expenses rather than expensing them immediately for losses of around $11 billion. And you can say this is sham sales or liberal return policies where there's uncertainty in recognition. Another example is Home Depot. 10% of their sales on average is returned each year. So that gives Home Depot a lot of scope for manipulating sales returns. If they have $100 billion in sales, then up to $10 billion in sales, they can work with in deciding, well, how much revenue do we really want to report? Do we want to say that we just had 9% of sales returns, and so then we can report 91 billion? Or do we want to say that we had 11% return of sales, so we report 89 billion, depending on what the analysts are expecting? Wow. All right. So this sham sales or fake sales can be used as a way of earnings management. So what I'm sharing with you is a little bit more in-depth of examples in different industries that relate to the whole list of different ways you can commit revenue fraud outlined in the textbook. So keep in mind, without getting blindsided by all of the examples in the textbook, maybe pick out some of those 25 big frauds in the table at the beginning of this part and just try and understand how 5 or 6 of them executed on those frauds and where do they fit in to the examples given in the textbook. That is a really great way of learning this material. So I would like to help you pick out some of maybe the top 12 accounting revenue frauds. And as I kept on looking for more and more and more, I found, I need to update this again. I need to update this again. And I think there's 1, 2, or 3 that are missing from that list that are in that first 25 list that I gave you at the beginning of this part. But this table is not necessary to show you whether it's a revenue, inventory, asset overstatement fraud, or a liability understatement fraud, or a disclosure fraud. This is to show you how the fraud was uncovered. Like, how was it found out? Okay. And if you look closely at this table, what I did was I got WorldCom, $11 billion, that's on the first list. How the fraud was executed. Expenses were capitalized rather than expensed, as I mentioned in the previous slide, creating an illusion of higher profits and healthier operations. And then I said, well, how was it found? Internal whistleblower. And how uncovered? The audit committee led a review into the practices of accounting. And then that's how the accounting symptom or the fraud symptom got found out. And so you can go through any one of these and have a look at, well, here are the tips or complaints. Notice that whistleblowers were involved in 3 out of the 12 revenue-related frauds. Notice that the CEO confession was involved, and for the others to be found out, they were found out by investigations by external parties, the federal government for Freddie Mac, Financial Times investigation for Wirecard, and you had allegations by a short seller, Muddy Waters, for Luckin Coffee, that Chinese company that listed in the New York Stock Exchange. And then we had inaccuracies exposed and regulatory investigation of Bankia IPO and so forth. So you've got a lot of exposures undertaken by external bodies, more so than whistleblowers or internal whistleblowers. You have 3 internal whistleblowers, 1 confession, making up less than 1/3 of these 12 examples of frauds. So this is another way that I want you to discover and uncover what Chapter 12 is about, and that is, how were they found out? And that helps you link back to the earlier chapters where we talk about the symptoms of fraud, and we're going to look at pretty shortly. And that is the symptoms of fraud. As I mentioned, I was talking about the tips, whistleblowing, but remember the others, the accounting and documentation go together, analytical, internal control weaknesses, excessive lifestyle and behavior. And as you'll see in this part and the next part and the next chapter, with these financial statement frauds, the heavy lifting of the symptoms come from the accounting and documentation and the analytical and the tips and complaints, because it is the senior management that are the fraudsters, that are the common fraudsters in these financial statement frauds. And you would expect senior management to have some level of extravagant lifestyle anyway. So it's hard to distinguish, oh, they're driving around in Mercedes, but they always drive around in Mercedes because their bonus is $1 million a year anyway. All right. So you cannot really discover these frauds by looking at lifestyle or behavior. The heavy lifting is done by the accounting and analytical. And as we saw in the previous table, tips and complaints. So let's have a look at this in more detail. If we look at the non-financial performance measures, this is one way of providing benchmarks to understand, is there a strange pattern analytically in the financial statements? Is there something strange accounting-wise in the accounting and documented transactions? And a big thing that's mentioned in the textbook, or a big example, we talk a little bit more in the next part about inventory-related fraud, you may want to count, well, how many feet of floor space would be required to warehouse the normal inventory for the amount of sales revenue that company X is reporting, and then go out and have a look and see how big is the actual warehouse they have. All right. So here is a lot of non-accounting information to compare the accounting information with, to get a better handle on, is something strange or is something normal with the balance sheet and profit and loss for this financial reporting period. And we can come back to this when we look at different analytical symptoms here, because there's 17 here where you can look at any of the sales revenue transaction accounts to see, are they too high? Are they too low? Is there something out of the ordinary? A lot of these could be uncovered through horizontal or vertical analysis, but also they could be uncovered by relating back to the non-accounting data in the previous slide, as I said here. So you could have a look at, okay, in a particular industry, what is the sales per square foot of retail space. And then if the amount of retail space hasn't changed from period to period and sales has doubled, then something is strange, all right? The sales per square feet has doubled, which that's pretty strange. But if they have actually increased the number of stores in that period and the sales per square feet of retail space ratio hasn't changed, then maybe that abnormal increase in sales is justified analytically in terms of the pattern that you are looking at. All right. So that's what I mean by comparing sales here with non-accounting related data here. And that's where you're using analytical patterns to discern whether the financial statements are usual or unusual or not. What about accounting and documentary symptoms? This is where you may have a look at specific documents, unsupported or unauthorized revenue-related balances or transactions, missing documents, or only photocopies of documents exist. You may ask the accountant in the firm, can we have example transactions of every one of your accounts receivables? Oh, that'll take a long time because we've got 800. That's all right. I want 800 documents. That will force the accountant to get a document for every one of your accounts receivables. Remember what I said at the outset? Let's create 801st accounts receivable because we want to book a fake sale. All right. That 801st, that first one, the accountant's going to have to make up a document to represent that accounts receivable if you as the auditor or fraud investigator is asking for every accounts receivable. As an auditor, you may be doing sampling, but as a fraud investigator, when you've got a hunch that there's something bad going down at the company, then you have a right to ask for everything. Okay. Remember, your salary is going to be big. Remember, fraud investigators are expensive when there's an alleged fraud taking place. All right. That's an example what we mean by looking for documentary symptoms. We could look at control symptoms, and there's a partial role of the auditor in all of these areas. I don't want to spend too much time about the auditor because we're a fraud investigation here, but you may ask questions about the internal control activities related to the revenue cycle. You may talk to the internal controller. You may talk to the accountant. The weakness in the cutoff processes. You may ask for documents around the final days of the cutoff and the week after the cutoff, transactions around that time. How strong are the internal control systems around the cutoff dates? Identifying revenue-related fraud symptoms, behavioral and verbal symptoms. Again, this is a smaller segment that will give you symptoms of actual fraud going on compared to accounting, documentation, and analytical patterns, but it's listed here for you to look at. And lifestyle symptoms, as I said, senior management, they must already have a good lifestyle, so it's going to be hard to find stuff. Unless there's something out of the ordinary, like significant bonuses or executives' net personal worth tied up in the company stock by a huge amount. Maybe they're paid a salary of $1 and then their only income is options related to the stock price. Now, I know Steve Jobs had something like that at one time, and I'm not saying that Steve Jobs was a fraud, okay? But I'm just saying that's something unusual. That's a heads up, a red flag to look out for, because not every executive has a salary of $1 and the rest in stock options. Identifying revenue-related fraud symptoms, tips, and complaints. And as I said earlier in that table, top 25, the top 12, notice tips and complaints made up at least 30% of the frauds that were uncovered. Wow. So that's just in the final straight of this part. Actively searching for revenue-related fraud symptoms requires you, as I said earlier, to look for financial balances and their relationships within the financial statements. And that's where we're looking for the horizontal relationships over time and the vertical relationships within each statement, horizontal, vertical analysis. Or we're comparing financial statements, amounts or relationships with related information, like comparing with the amount of stores open, the amount of square space, the amount of warehouse space, etc. Well, all right. And of course, we can use Benford's law. We can ask other questions around particular journal entries, asking the 5 W's: who posted the entry, what was the entry for, when was the entry posted, where was the entry posted in the system, and why was the entry posted. And like, you could not do this on 365 days of the year, but you may ask these questions around the last 3 working days of the accounting period and the first 5 working days of the beginning of the next accounting period. And it's more likely that you'll find something then. All right. And we can look for control symptoms. Most frauds are motivated by the fraud triangle. Remember, perceived pressure, the opportunity, and rationalization. So internal controls are all about preventing fraud. They're all about reducing the perceived opportunities. Okay, so you have good internal control system, but also you have to have a good tone at the top and a good non-fraud culture in place. All right. Remember what we said in the earlier chapters. All right. So you're always looking for weaknesses in these areas under internal control. When looking for behavioral and lifestyle, of course, we could look verbal inquiries, physical observations, and the UC 240 requires financial statement auditors to inquire of the following groups about possible fraudulent activity or red flags, to look and inquire of management, the audit committee members, internal audit personnel, and other employees. Interview them, observe them, question them, give time a chance to reveal their behavior to you, and you might pick up something. Finally, actively searching for tips and complaints. As I said, tips and complaints make up 1/3, if not even more, of the frauds uncovered, of the big frauds uncovered. Wow. How the big financial frauds get caught? Well, as I said 1/3, didn't I? Well, I actually went through some of these big ones. Now, not all of the 25 frauds are listed here, but here are the big ones. Whistleblower, 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 whistleblower. So nearly half of this list here were uncovered by whistleblowers. Have you got the message here? All right. The message is not to read every word in chapter 12 and chapter 13, but I want you to appreciate the range of frauds that are being undertaken. But at the end of the day, you need to be strategic in investigating the frauds and to realize that not all of these 6 symptoms are equally going to help you. In this area, chapter 12, chapter 13, it's more likely going to be analytical. It's going to be the accounting and documentation. You can do some observation, but you're also going to rely on whistleblowing and confessions by senior management. Remember, there was one CEO confession going on in my top 25. All right. So that brings us to the end of this part. In part 2 of chapter 12, we'll look at inventory-related frauds. I will see you shortly. Bye for now.